getting on, people? Luke here from LAGFX. We are back today with another Learn to Trade video. In today's video, we are going to go over everything you guys need to know about maximizing those profits and minimizing those losses. So in today's video, we're going to go over setting SLs and take profits. So that's going to entail the importance of a stop loss and a take profit, understanding why we place them, but also understanding where we place them. I think a lot of people get misconstrued on where we should be placing our stop losses and where we should be placing our take profits. So hopefully we're going to go through all of that, and you guys will have a better understanding. And then moving forward, you'll be able to implement my tips and tricks when it comes to actually placing your stop losses and take profits. Then what we're going to do is move over to risk to reward ratios. I'm going to explain what a risk to reward ratio is, why we integrate it into our trading, and why we implement it into our placeable positions. Again, understanding what it is, and then also how to maximize our profits using good risk to reward ratios. It's also important that we set expectations before executing positions. So I'm going to run over that as well a little bit, actual percentage usage and how much risk we should be integrating with our positions that we place here in the Forex markets. Me personally, I only risk 2% of my equity per trade. I know a lot of traders out there may only risk 0.5 or 1% of their equity. Me personally, my style of trading, my years of knowledge, I risk 2% of my equity. So if you are someone that is struggling with risk management, you're placing positions and you seem to be losing a lot more than you're winning when you are placing these positions, then it could be down to your risk management. You may not have your risk percentage set up. You may not have your stop losses and take profit positions in the right place. There are a lot of things that we can go through in this video to help ensure you are maximizing those profits and minimizing those losses. Okay, so moving over to the live markets, you'll see on screen I have highlighted the highs and lows of this bearish trend. How do we know that it is producing us with bearish structure? Well, evidently price started up here and it's ended down here. So that is one thing that we can look at. But on top of that, it is actually producing us with lower highs and lower lows in this market. Now, as we know, bearish structure does create lower highs and lower lows. Within this, we understand that the highs are protected. Now, what I mean by protected is price realistically shouldn't come up to break above these protected highs, because if price does do that, then we are no longer following bearish structure. So the highs are protected and the lows aren't. So we see that the lows break every single time. As you can see, this low has been broken by the creation of a new lower low. This low here was broken by the creation of this lower low here. Same applies. We have a structural low here that was broken. We saw price create a new lower low. Again here, we've seen price create a new lower low. This is clear bearish structure. Now, on the contrary, we have bullish structure. So in bullish structure, we have higher highs and higher lows. The opposite applies, however. So whereas the lows are now protected, the highs aren't. So we can expect that every high that is created within bullishness will be broken by the creation of a new higher high. As we can see, we have a high set here, comes down to set a low. We then have the creation of a new higher high, breaking the previous one, and we have a new lower low. Each low is protected and we don't see that break. So just going back to bearishness, as we know, lower lows and lower highs, if we see the last protected high break, what I mean by that is that price has come up and surpassed what was a protected high. We have now broken structure to the upside. This is then a suggestion that this bearish trend here has finished and we could start seeing the creation of bullishness. Why? Because with price creating a higher high within bearishness, that is now following the laws of bullishness, higher highs and higher lows. Now the opposite applies. So if we see bullish structure, higher highs and higher lows, but then we see a break of structure to the downside, that is then a suggestion that we are no longer following bullishness and we may be starting to see a new trend form creating bearish structure. So that is just a quick introduction onto bearish and bullish structure. If you want more detail within that, then head over to our Learn to Trade playlist. We have 2 videos on breaks of structure and displacements in the market. They are brilliant. If you're looking for reversal patterns and reversal trades, then they are the videos that you need to be watching, because they will enhance your knowledge within Forex exponentially. Now, you may be wondering, well, why is this even relevant? Why do we need to understand lower highs and lower lows, higher highs and higher lows? Well, because our stop loss depends on it. So if we see a bearish market, price is trading lower, we obviously want to be trading with the market. So we want to be looking for selling opportunities. We don't want to be buying against the seller market, because we are probably going to lose 9 times out of 10. So when it comes to placing these sell positions in a bearish market, where is the best place to place them? Well, obviously at the start of an impulsive wave and the end of a correction. This is the start of the next impulsive wave, this being an impulse. This is the starting point of the impulsive wave, this being the impulse. This is the start of the impulse, this being the impulsive wave. Okay, so these are impulses, and then these are small corrections where price is having to retrace itself before taking that next move lower. So we obviously want to be getting involved in a bearish market at the peaks that are created. Okay, so make note of that. When looking for sell positions in a bearish market, we want to be looking to get involved at the peaks of a market. On the opposite side, however, if we were looking to get involved in a bullish market, we want to be looking for buy positions, so we are trading with the trend, and we would be looking to get involved in buy positions around the troughs that are created, so the lows that are created within the market. Now, I'll have thrown up some illustrations there for you, so please pause the video, go back, take screenshots of them so you have them. I know it's very basic information, and for anyone who's not a new starter, I know you probably understand this, but it is very important that you do understand it when it comes to us actually talking about our placements of our stop loss. So let's say that we place a short position here. We understand that the correction has finished and that we want to get involved in this impulsive wave. So we place our sell position here because we've had confirmation fractally that price is ready to put in its next impulse. Where would we place our stop loss? Would we place it just above the candle that's been created? Would we place it here? Would we place it all the way up here? Where would we place it? Where is safe and where is going to offer us with a greater return? Okay, so me personally, I place my stop losses above structural highs when I'm looking to sell into a market, and below structural lows when I'm looking to buy into a market. So just using this sell position as an example, I would place my stop loss just above this structural high that is created here. Now, again, you might be wondering, well, why are you placing it there? Well, as we know, in bearish structure, lower highs and lower lows are created. The highs are protected and the lows aren't. So realistically, if price was to continue trailing down, as it has done here, when it comes to take its correction, price shouldn't come to correct higher than the previous high that is created. Why? Because that isn't following the laws of structure. It will always go on to set a new lower low, as it has done here. So setting our stop loss just above this structural low is actually protecting our stop loss from being struck. So we can see that our stop loss is protected, price goes on and trades lower, price then comes up to put a correction, which doesn't even put us into a drawdown. Price is still in profit at this point, and then price goes on to set a new impulsive wave lower, generating us with greater profits. Now again, the question will come, well, where do we put our take profit? I always, with a bearish position, so with a selling position, I always set my take profit at the previous structural low. So just here, for example, so if this is the structural low here, we want to ensure that our take profit is set just above that so it's safe. Now the reason for this, and I'll explain why, is because within bearish structure, we have the creation of lower highs and lower lows, as we know. So we understand that when price is putting in this impulsive wave, we know that it is going to come lower than the previous structural low. So we can guarantee that our take profit is going to be achieved pretty much every single time. Now, yes, we could stretch it further because we understand that a new lower low is going to be created, but we don't know when price is actually going to reverse to grab more supply from the upside. So it is important that to be safe, we set it just above the previous structural low. As we can see here, we have a risk to reward ratio of a 1 to 3. Now, what I'll do later is I'll go more in depth with risk to reward ratios, but just remember that this position here is offering us with a 1 to 3 risk to reward ratio. So just be brief, if we are risking £10, we are looking to earn £30 back from this position. Now again, we place another short position here because we understand that this correction has finished and we are expecting and anticipating the creation of its next impulsive wave. Again, where do we place our stop loss? Yep, as you said, just above this structural point here. Where would we place our take profit? Yep, just above the last structural low that was created. Why? Because we know that our take profit is more than likely going to be achieved every single time. Again, as we can see here, we have a risk to reward ratio of a 1 to 3.75. So again, if we were risking £10, we're looking to gain back £37.50. So that's just an example of bearish structure. So placing positions based on bearish structure. As I said earlier, we want to place our stop losses just above the structural highs, take profits just above the previous structural lows, just to ensure that they are hit. Okay, so what I've gone ahead and done is actually zoomed in on the same market at one of the corrections, just so we can use this bullish correction as an example. But as you'll see, we can use this on all time frames. This applies to all time frames. Depending on what time frame you are going to be using will depend on what structural lows and highs you consider as protected and valid, okay? So now we are looking at the 4-hour time frame. We have zoomed in on a correction. The overall structure of this market is actually bearish, as we came to realize at the start of the video, but we have just zoomed in now on one of the corrective waves. So looking at this, we have clear bullish structure. Again, what I'm going to do is just highlight out this bullish structure just to give you guys a better understanding. So without being too specific, I have just drawn out the structural lows and highs. I've not been too specific with the actual fractal structure within them. But as we can see, we have the creation of higher highs and higher lows. So if we do the exact same thing that we did last time, so we marked out the lows and then we mark out the highs. Perfect. Okay, so we have the creation of higher highs and higher lows. As we know, this is clear bullish structure where the lows are now protected and we understand that every high that is created, we can expect price to come and surpass to create a new higher high. This has happened every single time. So because we are now trading in a bullish market, we want to be looking for buy opportunities. We want to be looking for buy positions. Okay, so we need to be looking to get involved at the end of these corrections. Like we did with our bearish market, we want to be looking to get involved at the end of a correction and the start of an impulse. So this here is an impulse. This here is an impulse. This here is also an impulse. These are just small corrections in between our impulses. So we want to be looking to get involved at these red lows that I've highlighted here, here, or here. Now, the exact same thing that we did with our bearish market, we want to do with our bullish one, but you'll notice there is a slight difference. Now, obviously with the bearish market, we placed our stop loss just above structural highs. With the bullish market, we want to place our stop loss just below structural lows. Now, as you've guessed it, our take profits will be set just below the previous structural high. So the exact same rule applies, just the opposite way around. So we want to place our take profit just below this, as we can guarantee that that is going to be struck because we understand in bullishness, we have the creation of higher highs and higher lows. The lows are protected, so we place it just below the higher low, and we can expect a new higher high to be created, so we'll set it just below the previous structural higher high. As we can see here, we are offered with a lovely risk to reward ratio of a 1 to 4.7. So for every £10 that you are risking, you are looking at gaining back £47. Again, we place a buy position here. This time setting our stop loss just below this structural low. Our take profit set just below the previous structural high, being here. And as we can see, take profit is again achieved, generating us with a generous risk to reward ratio of a 1 to 8.7. Every £10, we're looking at £87 profit. So you can see that by just following these basic rules, we can guarantee that our take profit is going to be achieved every time, and we can also see that our stop losses are protected. Now, just zooming into this structure, just to give you a really good example of how the lows are protected and how the highs are protected when it comes to bearishness. If we place the buy position here, we would have our stop loss set just below the structural low. And as you can see, price came in to put in an impulsive wave, but then followed with a correction. Now, this correction that it put in came higher than our entry point, and the correction concluded higher than our previous structural low, where our stop loss is residing. Now, this is because enough demand has been introduced at this point to push price higher, so when price comes back down to grab more demand, it doesn't need to come as low. This is why we place our stop losses in the places we do, because price is following bullish structure and it is following the bullish laws where price doesn't come to break those structural lows. So we can see that eventually price does actually go on to take profit, generating us with a brilliant risk to reward ratio. Now, what I want to do now is go down time frames again, show you that these structural laws still follow and that we can still implement these when we are placing our stop losses and take profits, and show you how if we don't follow these rules, they can backfire. So as we can see, bearish structure, we have the creation of lower lows and lower highs within this fractal bearishness, okay? So we have a double top that's formed, followed by a low. It's come to set a lower high, price has set a lower low, price has then set a lower high, price has then set a lower low. Then we actually have the creation of bullishness because we have a new high created, followed by a higher low, and then higher highs, okay? This was the point here at which price switched from bearishness to bullishness. So let's just say that we followed our rule and we placed our position, our sell position here. Our take profit was set at this point, just above the previous structural low. Stop loss set just above the structural high that was created. We can see that we walk away with nearly a 1 to 2 risk to reward ratio, which is great. Then we go on to place another position, okay? So this time we decide, right, well, actually I want to stretch my take profit further because I feel that price is going to surpass this previous low and continue trading us lower for a longer period of time. So our position, my position, being safe, I would have placed it here like so. Take profit would have been achieved. We would have walked away with a lovely risk to reward ratio of a 1 to 2.78. Now, if you are someone who was being a bit greedy, someone who wanted to, stretch out those profits, they placed our stop loss at the same point, but they stretched their take profit far lower. We can see that they would have or could have generated greater returns, but you'll see that price actually came up and eventually stopped them out. Now, this is because they allowed greed to take over within their strategy, their trading plan. They allowed greed to take over the decisions that they made, and they paid for it. So this is why it is extremely important that we follow a very strict plan and trading strategy when we are placing our positions. Now, a positive that we can take away from this is that price did, yes, stop us out, and we may have lost 1 or 2% of our equity from this position. But what it does tell us is that we are no longer following bearish structure. Therefore, we don't want to be involved in sell positions in this market because price is actually going to continue trading us higher. How do we know that? Because as you can see, we have a break of structure to the upside. So this was a protected structural high. Within bearishness, we know the highs are protected, the lows aren't. So this was actually seen as protected. Price has come up to surpass this. So this is a break of structure, telling us that we are no longer following bearish structure or the bearish laws, and we are now following bullish laws. How do we know that we are following bullish laws? Because as we know, in bullish structure, the highs are broken every time and the lows are protected. So this high was broken and we've had the creation of a new higher high. If we look, we can see that price continues to trade us higher within this market. Just zooming out slightly, you can see that we have the creation of clear bullishness. So we were right to set our stop loss just above this structural high here, because we don't want to be involved in sell positions if the market is going to continue trading us higher into this market. By leaving a position open or not having a stop loss at all, it is going to lead in large equity losses. So now, after showing you that, the structural laws of the market and why we should follow them religiously, I hope you guys have gained a better understanding as to where and why we should place them where we do. It is extremely important that with every position we place, we are always applying stop losses and take profits, because as we know, these are automatic executions that take us out of positions whether we are losing or gaining. Now, it is quite self-explanatory, but what I'm going to do is throw up a little blurb that I wrote up explaining in detail what a stop loss order is. I've already gone through it, and also what a take profit order is. Again, I've already gone through it, but just to give you guys a better understanding. Okay, so a stop loss order is set up to automatically close a trading position within the trader's risk profile. So me, as I said to you earlier, I risk no more than 2% of my equity. So a stop loss order is a defensive mechanism that can be initiated to protect an order against deeper losses that would fall beyond your set risk per trade placed. As I said, LAGFX risk no more than 2% per trade. A stop loss is most commonly placed somewhere that if price was to reach, it would disregard the trader's analysis completely, in which case the trader no longer wants to be involved in that market as it is not trading in the desired direction. So as I say, we are wanting to be sellers in this market, trading lower, so we want to look for sell positions because it's a bearish market. But if price was to break this high here, this protected high, this would then tell us that we are no longer following bearish structure, but we are in fact now following bullish structure because we've had a break in what was seen as a protected high. As we know, protected highs with bearishness, protected lows with bullishness. Okay, now take profits are the opposite. Take profits are good things. A take profit order is something that is placed at an area that we believe price can go to and is achievable. So this is a type of pendant order that is placed to close a profitable position once the market reaches a specific price. As the name suggests, it allows the trader to set a predefined level to lock in any profits. So this means that we can do our analysis, we can have our bias in the market, we can set our stop loss and take profit orders, and we can go on with our day. If stop loss is hit, then yes, we are out of the trade and we have lost our set risk, but at least we are not getting ourselves into a further drawdown. If take profit is achieved, however, we have profited from the market and we have got out at a place we feel was both achievable but generates us with some good returns. So just to give a quick example, a trader executes a buy position by entering the market at say 0.5960, expecting price to rally higher. He wants to benefit from the rise, so he places a take profit order at a level higher than the entry price, let's say 0.6070. Then if the bid price goes on to hit the predefined take profit price at 0.60670, the position has actually closed for plus 100 pips and profits are then locked in. So we have gained from that exchange in price and that change in price. Now you may have heard within that example I used the term pips. This stands for point in percentage. What I'm going to do is go over risk to reward ratios, and I'm going to actually integrate pips and the use of pips, why we use pips, what they're used for, and how our risk to reward ratios are actually calculated, okay? Because as we can see on screen, we have great risk to reward ratios with every single trade that I have gone through and I have given examples on. But you may be wondering, how are they actually calculated? How do we put those in on our phone, on our computers when we place our positions? And how do we know, what risk to reward ratio the trade I'm placing is? And I'm actually going to go through that in greater detail in our next video. I don't want to leave this video too long, so rather than splitting it up into a 2-part series, I think I'm actually going to split it up into a 4-part series. So we've gone through setting SLs and TPs, where we do it, why we do it. In the next video, we're going to go into greater detail with risk to reward ratios, everything you need to understand about risk to reward ratios, how we can rinse the markets when it comes to risk to reward ratios. Then we're going to go over calculating our lot size. How we do that, I'm going to give you guys a formula that will probably be quite a quick video, and then we're going to finish off with minimizing risk and maximizing profits, talking about partials, all these tips and tricks that I have learned over the years to really make the most out of the positions that we are placing. So if you have enjoyed this video and you've learned from this, you understand now, okay, well, I should place my stop losses here, I should place my take profits here. Brilliant. That was the main goal of this video. Always place your stop losses and take profits at structural points within the market. And to end this video off, always ensure that your risk to reward ratio is at least a 1 to 2. Okay? And if you understand pips and you understand what points in percentage are, then you want your take profit in pips to always be at least double your stop loss in pips, okay? That would give you a 1 to 2 risk to reward ratio. Now, that doesn't mean to say that you should just, if you have a stop loss of 20 pips, because that's what it needs to be, that you'll just place your take profit at 40 pips, because that gives you a 1 to 2 risk to reward ratio. You should never do that. You should only ever place positions and execute positions that allow you to have at least a 1 to 2 risk to reward ratio without it jeopardizing your analysis in the first place. If you are having to stretch out your take profits just to give you a positive risk to reward ratio, you shouldn't be placing those positions. Now, without blabbering on too much, I hope you guys have enjoyed this video. If you have done, please leave it a thumbs up, and I'll catch you guys in the next Learn to Trade.